The Fed has just delivered its third and final rate cut of 2025. And in this video, I want to dive into what this really means for the markets. Will stocks continue climbing, or are we setting out for a pullback? I also want to look at what Howard Marks thinks about whether we are entering a bubble, and if he's right, what will this mean for investors from here? So in this meeting, the Federal Reserve lowered its federal funds rate by 25 basis points, bringing the target range to 3.5% to 3.75%. This move was completely in line with what the market expected. Though interestingly, President Trump was hoping for a much larger cut, calling Jerome Powell a stiff who approved of only a rather small cut. According to Jerome Powell, the Fed now feels well positioned to wait and see how the economy evolves. In other words, the Fed is signaling that there's no urgency to cut aggressively from here because inflation is easing at a manageable pace and the economy is still holding out well enough for them to be patient. Additionally, Powell also mentioned that he does not believe a rate hike is anybody's base case at this point, which basically means that the Fed is not considering raising rates now, but rather will be more focused on policy easing in the future. Indeed, if we look at the latest dot plot, which shows each member's projection for future interest rates, we can see that members of the Fed are now split on where the rates should go in 2026 and 2027. Some see almost no change, while others see several cuts. But if we take the median projection, it points to just one additional rate reduction in 2026 and one more in 2027. However, the market sees things very differently. According to the CME Fed Watch 2, traders are currently pricing in 3 rate cuts in 2026. Immediately after the rate cut announcement, the market went up a little. The S&P 500 rose about 0.7% and the Nasdaq saw a similar gain, although that did not save Oracle from crashing after missing earnings. But then, right after that, the market turned negative again. However, the bigger question I want to answer is, what does this rate cut mean for the stock market going forward? First, we are currently in December, and December has historically been one of the strongest months for US equities. Based on long-term data since 1950, the S&P 500 has finished December in positive territory about 77% of the time. And in roughly 75% of the time, the index delivered an average return of at least 3.8%. Even a bad 25th percentile has seen the market giving an average return of 0.2%, which is easily the best of any month. This effect is commonly referred to as the Santa Claus rally, where from a seasonal standpoint, the odds have generally favored the bulls in December. And right now, the S&P 500 is only up about 1% since the start of the month. So if this historical trend plays out, there's room for further upside. Ho ho ho. On top of that, the S&P 500 is currently trading very close to its all-time high. Historically, when the Fed has cut interest rates while the index was within 1% of an all-time high, markets did experience some short-term volatility in the following weeks. But the further out you look, the stronger the odds of the markets ending higher. Subutrade's analysis shows that over the first month, the chance of the S&P 500 ending positive was only about 50%. But by the second month, the odds rose to 73%. At 3 months, 71%. And 1 year later, the market was positive 100% of the time, while delivering an average return of about 15%. In other words, historically speaking, a rate cut near all-time highs has always been a good sign for the markets over the medium term. However, this does not mean that the market will what all the way to 2026 without any drama. Historical data also shows that during these 1 year periods, there were also meaningful drawdowns along the way. For example, over the 1 year horizon, the S&P 500 saw maximum drawdowns of around negative 26%, and on average, the pullback was closer to negative 8%. This means that even when the market was historically bullish, investors should still expect short-term corrections and sentiment swings. Now, looking ahead, analysts are broadly bullish going into 2026. At the very minimum, Bank of America forecasts roughly a 3% increase from today's levels, while over at the other end, Deutsche Bank and Capital Economics expect gains of around 16%. But if you simply take the median, analysts are projecting about a 9% gain for the S&P 500 by the end of 2026. That being said, it's important to take these predictions with a heavy pinch of salt. Historically, Wall Street forecasts are almost always wrong in terms of exact numbers, as they cannot account for unexpected events, geopolitical shocks, or shifts in economic conditions. Still, if things go according to plan, Factors such as low interest rates, stable inflation, and continued earnings growth could provide a reasonable foundation for the market to finish 2026 in the green. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. But wait, isn't there an AI bubble forming this very moment? If we are buying in now, wouldn't we be caught when the market booms? I think there's no denying that we are in some form of an AI bubble right now. In legendary investor Howard Marks' latest memo titled "Is It a Bubble?", he explains that there are clear parallels between today's AI excitement and past periods of speculative excess, especially in how optimism and FOMO can push valuations far beyond fundamentals. He quotes, "Given the amount of debt now flowing into AI data center construction, I think it is unlikely that AI will be the first transformative technology that isn't overbuilt and doesn't incur a brief painful correction." In other words, every major technological revolution, from railroads to automobiles to the internet, was massively overbuilt, and AI is unlikely to be the exception. However, despite these bubble-like characteristics, Marx also emphasized an important point. Today's environment is not yet as irrational as the dot-com bubble. During the late 1990s, companies were trading at sky-high valuations. But today, the valuations are not yet detached from reality. Well, except maybe Tesla. That one is still trading at the super high multiples. But there's another story altogether. More importantly, unlike the internet bubble where many companies had no real products, AI applications already exist at global scale. Demand is exploding, adoption is real, and revenues are growing extremely rapidly. For example, Anthropic, one of the leading AI model developers, is said to have 10x its revenues for 2 consecutive years. That kind of growth simply did not exist in the early stages of the internet boom. But here's the interesting part. Howard Marks admitted that while there is no doubt investors are showing exuberance toward AI, the real question is whether that exuberance is irrational or not. He wrote that given the enormous potential of AI, but also the enormous number of unknowns, virtually no one can say with certainty what the right valuation should be. We can theorize about whether enthusiasm is excessive, but we will only know years from now whether it was truly a bubble, because bubbles are best identified in retrospect, not while they are forming. And since no one can say definitively whether this is a bubble, he advises against taking extreme positions. Nobody should go all in without acknowledging the risk of ruin if things go badly. But at the same time, nobody should stay all out and risk missing what could be one of the most important technological breakthroughs of our lifetime. I've seen many people confidently calling the top, shouting that the bubble is here, and predicting that a crash is coming soon. And yet, the market keeps proving them wrong. Even Michael Burry, who famously predicted the housing crisis, has repeatedly tried to short overvalued stocks, only to eventually close down his fund, and admit that sometimes the only winning move is to not play. Now, I guess this message could be interpreted in many different ways. If you ask the bulls, they will tell you it means you should never short the market. If you ask the bears, they will say it proves that you should avoid investing when valuations are high. But to me, it says something much simpler. Trying to guess where the market is going next is a losing strategy. The best approach is to stay invested regardless of whatever is happening in the short term. In Tom Lee's latest video, he talks about something called the rule of 10 best days. So what's happening right now is that investor sentiment was pretty much bearish for the entire year. And there were only 12 weeks where sentiments were positive. And yet, the markets still finished higher. Why? Because the S&P 500 makes most of its annual return in just 10 days. Since 1928, the S&P 500 has returned about 8% a year on average. But if you simply exclude the 10 best days each year, the average return drops to negative 13%. All the long-term gains would vanish just from missing the 10 best days each year. You can see this clearly in recent years. For example, in 2023, the S&P 500 gained 24%. But if you exclude the 10 best days, the return would fall to just 4%. In 2024, same thing. The market was up by 23%. But without the 10 best days, the markets would only be up by 4%. Likewise, in 2025, the S&P 500 gained 16%, but missing the 10 best days would turn that into a negative 12%. What's really interesting is that in 2025, the single best day of the entire year happened in April, when the market surged 9.5% after the big drop during Liberation Day. And if you were sitting out of the market when this happened and waiting for the market to come back down, you will have missed out on the strongest 6-month rally we have seen in more than a decade. Now, don't get me wrong, even after seeing so much evidence that points that we could be seeing another good year in 2026, I'm not saying that we will definitely have a good year. If anything, the S&P 500 price to earnings ratio shows that the market is getting expensive. And history tells us that when valuations reach these levels, the 5-year annualized returns tend to fall close to zero. Whether that will repeat this time, I guess time will only tell. What I'm saying is this: don't try to time the market. For most investors, the best strategy is to stay invested through the cycles. Keep a long-term mindset and position your portfolio in a way that can survive both rallies and corrections. As for how I'm personally dealing with today's elevated valuations, I'm doing two things at the same time. First, I'm adding more into global index fund to reduce my over-reliance on the S&P 500. That way, even if the S&P 500 underperforms or goes through a rough patch, I still have exposure to other regions and economies. Second, I'm avoiding hype and only adding to stocks that I believe are fundamentally good and undervalued at the same time. For example, I think Palantir is a fantastic company with great fundamentals, but in my opinion, it is overvalued right now, so I'm waiting for a better opportunity to get in. On the other hand, I've also been slowly accumulating companies such as Meta, Netflix, and Adobe. All of them have strong fundamentals and, based on my analysis, look undervalued at their current prices. Now, of course, this is not financial advice, and I'm not asking you to buy these stocks. I'm just sharing how I manage risk in an overvalued market. At the end of the day, nobody knows exactly what will happen in 2026. The Fed could cut slower than expected, earnings could surprise, geopolitical risk could flare up, or optimism around AI could start to cool down. So rather than worrying about what might happen, the best approach is to stick to a long-term plan. Because in the end, history shows that it is the disciplined investors who stay invested who will almost always come out ahead. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe, as I'll be posting new videos every week.